Well, good morning, everyone, and thank you very much, Chairman. Thanks to everyone for coming along today. It's great to see so many of you here. And as always, as you come to expect, this is going to be quite a fast-paced morning. There's a lot of information coming your way. The vast majority of information you've got in your packs on the printed slides. There are some adjustments. Unfortunately, markets don't stand still for our conference, and so the data continues to be live, and so we need to reflect that in the slides we've got. So we've got 49 slides. We've got about 45 minutes, so hold on to your hats, and we'll crack on. In terms of structuring this year's Outlook paper, it's quite a traditional structure. We're going to start by looking at the global grains perspective, and we're going to break out into the different commodity groups. On there, you've got a one-word description for each of those commodities. We're then going to zoom back into the European situation, and we're really going to focus on the total grain situation for a short period of time. It's always important to focus on the total grain situation, more so this year, though, particularly for Europe, do we need to consider the overall grain position before we break out into the individual commodities. And then, as always, we're going to break into the UK situation and see how we're interfacing with this market, what's going to drive it, and what are the things we need to look out for. Just before we really get into the guts of the outlook, I just really want to remind ourselves what's at stake here. And I really want to take you through very quickly what I would call volatility in action. The graph up here is basically looking at November 14 feed wheat futures over the last year, essentially since that subsequent crop got planted. With that graph, we're tracking a post-planting moving simple average and a post-harvest simple average, two very achievable averages depending on the type of strategy a seller in this state of case is going to take. But look at the variation between the two. At last count, £27 a tonne between two very achievable averages. Just to put that into context for you, if we relate that to some budgeting work we did back in July, and we assume that over a 9 tonne per hectare crop, that essentially equates to around half of the variable costs of growing the 2015 wheat crop. I hope this demonstrates to you what's at stake here when we're talking about volatility and the extreme nature of price risk management and why it is so important. I'm not standing here, though, and telling you with the benefit of hindsight, you should have gone and sold pre-harvest, because I'll put another graph up there and show you what we saw 2 years ago. The complete opposite on the 2012 futures because of those huge weather events that we saw. This stuff isn't easy, but it's present in our marketplace, and volatility really does matter now. And essentially, I still see volatility as a massive opportunity for UK farming, UK arable farming. We need to make sure we keep it as an opportunity and we don't let it become a threat. And to do this, we need to be using sophisticated tools, and we need to be having sophisticated conversations within our supply chains. That just really sets the scene for you in terms of my thoughts around these markets and what do we do. I now really want to get in quickly to look at the global grain perspective. And to do this, really to start illustrating to you the sheer nature of production that we've seen around the world this year. The green bars here, we're looking at production of both coarse grains and wheat. This data comes from FAO, and we need to look at this in the context of that black line, demand, that ever-increasing trend line of demand. Demand is usually quite boring. Everyone jumps on the bandwagon of demand. Demand's growing, demand's growing, demand's growing. Yes, but the market knows that demand is growing, so it's not really a driver of volatility. All with the exception of what we saw in 12-13 was a very extreme year. So essentially the market's looking at its second consecutive surplus of global grains. That comes after last year's surplus. Last year's surplus was really about stabilising grain stocks around the world after the extremes of 12-13. This year's surplus comes on top of those, and if we can put this in the context of what that means for current expectations for stocks-to-use ratios, we can start to see why the market is doing what it's doing. Stocks-to-use ratios, the top line there is for wheat, and we can see that that's expected to build again. Probably the more important one to the headline global price movements is what's happening in coarse grains. Again, a second consecutive building of that, and the latest FAO data suggests that we could be looking at a stocks-to-use ratio of over 20% on the coarse grains. If that's realised, then that will be the highest level in at least 10 years. And so this is giving huge amount of confidence to the spot market over grain supplies. The spot market no longer has to be concerned about the supply of grain. I say the word spot market. Longer term, the market is fully aware that demand keeps creeping and we're only ever one weather event away from drawing down grain stocks. Just to give you a real global understanding of what's going on in terms of grain production, you've got these figures here, and you can see the three main exporting regions of the Northern Hemisphere have had very good years. That's the first bearish signal that we've seen. In East Asia, dominated by China, it's another good year. It's not been rosy everywhere. Import regions, particularly North Africa and the Near and Middle East, have had some issues, and so those are going to be key target markets for exporters. And soon the focus turns to the Southern Hemisphere, where the weather, once again, is going to become hugely important. Let's touch on prices and the impact that that's had. Now, we're all aware of the general trend in prices, but this is a really dangerous year to be jumping on general trends in prices. We've been led lower to an extent by the broken line, which is maize, but just look at the sheer level of variation in those wheat prices. This is not a year to generalise about wheat prices. Comparing the price of different grades of wheat is almost like comparing apples with pears this year. This is the year where wheat isn't wheat. It very much depends on the type of wheat that we've got in the marketplace. I want to touch on a subject now, looking at really some bigger picture stuff, and really looking at how we're changing, or how the prospects for wheat and maize production around the world is changing. We've got two lines here, really since the turn of the century. The top line looking at global maize production, the bottom one looking at wheat. The solid lines take us up to the current day. The broken lines are the projections from USDA for the next 10 years. We will soon be talking about maize crops of around 1 billion tonnes within the next few years, probably even building upon that. In recent years, 2010, 11, 12, we got very used to maize really being a bull driver in the market, disappointing US maize yields, really tensing up the supply of feed grains around the world, and that giving us support. We're now coming into an era where we should expect maize to have just as much an impact on the downside on prices because of that yield growth that we're continuing to see. And it's one of the big issues is, and relates back to the comment of having more eggs in fewer baskets, comes back to the dynamics of the maize export market. With 4 dominant maize exporters, US, Argentina, Brazil, and Ukraine, all account for about 80% of global maize exporters. We compare that to the wheat market, the top 4 exporters only account for 63% of the market. So we're concentrating the risk in fewer parts as we're doing more and more, increasing the dominance of the maize market. And so that brings risk with it, weather risk. Let's just focus on the US for a minute. US is a big player, is the dominant force in the supply of this feed grain to the world market. And let's have a look at some data. So we're looking at ethanol demand now, and we're looking at the 10-year projection data that we get from the USDA every February from the baseline. And we can look at the 2002 projections, which essentially told us that the US was going to start using 20 million tonnes of corn or maize into ethanol. Let's fast forward 4 years, 2006. Just look how that demand growth came forward into 2010. That's what has characterised a lot of feed grain demand in the last 10 years for the global market. Let's look at the 2014 numbers, though, and that demand growth is now plateauing. Ethanol we should be looking at it as a very mature industry now, and not necessarily giving us the same level of demand growth that we saw over the previous 10 years. So that provides the US market with a challenge, because we still expect US maize yields to keep growing. The arrival of more technology, the trend line is still growing for US maize yields. So where's that production going to go? Perhaps the US market needs to revive the export program, and that's potentially one of the areas we need to be aware of. This is where we bring in China to the mix. China's policy towards maize is changing. We need to consider agricultural policy in China is very broad. On one side, we've got soybeans, where there's no real desire to be self-sufficient, very happy to interact with the world market. On the other side of the extreme, we've got wheat and we've got rice, a huge desire to be self-sufficient, but a need to dip into the global market as and when required. We've always assumed that maize has been towards the wheat end of the spectrum. Now we're seeing maize drifting into that middle area. China is more and more accommodating of the fact that it will have to interact with the global maize market. We saw a lot of it last year. This time a year ago, China had either bought or imported over 3.5 million tonnes of US maize. However, at this point now, it's only 73,000 tonnes. We saw huge issues in terms of phytosanitary, with unauthorized GM events going in US cargoes, and there are reports that even though Brazil has had a phytosanitary agreement with China since November 13, that's causing a slowing issue. So China is very good in the grain, in the feed grain market, has a huge amount of influence, but it very much depends on what the need is, and it's not consistent. So when we're talking about China and imports, we cannot apply the soybean model to the grain market. It's a very dangerous thing to do. Let's just touch on ethanol very quickly. I'm really pleased that we've got Patricia here to give us an update and her perspective, because the ethanol market is becoming that much complex. We can look at the headline economics, as we hear here, by looking at the ratio between feed grain prices and crude oil. That gives us a headline view of the economics, but the situation has become very, very complex, and so it's very important that we have a firm understanding of what's going on there. That brings us to the end of the global maize summary. You've got that to take away and to read in your own time and to digest. I want to quickly move into really the global wheat situation. This is the only generalist graph I'm going to present you to on the global wheat. It's very dangerous to be generalizing about wheat this year, so I'm not going to spend too much time. Headline figure is that the world is looking at record production, met by growing demand, and what we're starting to see actually is a little bit of demand creep. We saw on Friday's USDA report a little bit of extra demand creeping in and sort of building the levels up. And this, although it's still giving us a surplus, and we're still expecting to see, a fairly stable stocks-to-use ratio at the headline level. That's as general as we can get on the wheat market, because we really need to really explore the specifics of what's going on and what's going on with the quality. What we've got here is just a graph looking at the export prices for key destinations at the bottom here. You've really got the commodity end of the wheat market. We've got the French wheat, we've got the US soft red winter, and we've got the Black Sea grade 4. And that's sort of the traditional battleground for wheat, if you will, and one that tends to lead the direction of the general market. Interestingly, though, that the Russian wheat, after very rapid export progress in July and August and into September, has actually seemed to dry up. That's quite surprising that we've seen that early exit from Russia. I don't know if we've seen the back of Russia in the export market. We possibly haven't, given the size of the crop that everybody thinks that is there. But look at the top of the market, look at those high protein markets, and look at the gap that's developed between the two. This really illustrates the sheer variation that we've got in global wheat markets right now, because essentially of the quality issues driven by, in part, the protein issues we have here. We saw it again on Friday in the USDA data. We saw export sales of hard red spring, high protein wheat, just edging that little bit higher, taking the edge off US wheat stocks. And so the market is responding to this, and we're having a very, very segmented wheat market. Let's just have a quick trip around the houses, and the headline really on terms of wheat production is that the quantity isn't the issue, it's the quality, and it's having the awareness of those detailed prices. We'll get into EU later. We see a much more normal Canadian crop this year, down 8.3 million tonnes from the big crop we saw in 2013. That, however, is offset by slightly higher stocks. But the issue for Canada is one of logistics, and Canada is our latest, almost case study example of challenging logistics around the world. Before that, it was about Brazilian soybeans. And we need to look at the context of the whole market. Over the next 10 years, USDA expect that global grain trade will increase by 23%, essentially as demand growth is dislocated from production growth. This is going to require a whole lot of logistics to deliver and move that grain. And the question is, are we seeing the level of investment around the world to basically deliver those logistical elements? And that's important. So don't be surprised if over time we start to hear more about creaking logistics, either internal or port logistics. It's a very, very important factor. And it's an important factor of delivering price signals back to the farm as well. There's a few elements there we're going to touch on later. Just quickly, it's important that we appreciate what's happening in India. It's almost taking a little bit of a back seat this year. And India and China, to an extent in the wheat market, their farmers will experience different price signals to the rest of the world, in that we have a huge presence of minimum support prices, and really as a function of food security. Take India, for instance, record crop supported by weather, but supported essentially by a further increase in the minimum support price. 15-16, another increase in the minimum support price has been recommended, all part of the National Food Security Act, and all very much driven by this need for food security. What we could be looking at are WTO issues, but probably not this side of 2017. But so Indian wheat becomes more of a political beast rather than a market beast at the moment. With the lower global prices, Indian wheat is essentially is uncompetitive on export markets right now. Let's touch on global wheat importers. And the key thing with wheat importers, we all hear about Egypt and when they've bought French, when they've bought Russian, when they've bought US. And we all seem to be drawn to what the big importer does. Well, it's not really the big importer, it's the top importer, but because the import market is so diverse, actually what happens in Egypt is actually a relatively small part of the overall market. So let's not get too drawn with specifically what's happening there. Coming back to the China point, what we saw last year was China storming into the top 10 as a big importer of wheat. And again, we saw complacently quite a lot of soybean models placed on top of that and saying, looking at the growth we saw in soybeans and applying that to wheat and say, well, China's just going to import loads more wheat, isn't it? Unfortunately, that's not the case. We see China dipping in and out when it suits China. Supply, security of supply, self-sufficiency is still the #1 objective. So we're not surprised to see China isn't in the wheat market this year buying rafts of American wheat. Let's just focus quickly on a key importing regions of the world. So we're looking at North Africa and the Middle East here. And this is key on two fronts. Firstly, we've had some key production issues. Let's have a look first at Algeria. That's been well understood, been dry conditions, so hopefully an outlet for UK wheat directly. That's been well discussed. Similar issues in Turkey. And an interesting one is what's happening in Iran. Iran's been sort of quite opaque, and we've not really discussed it, but with the whole changing political scenario going on in that part of the world, Iran is becoming more acceptable to Western exporters. So we may well start to hear more about Iran. There's a bigger picture issue to consider as well, and are we going to see key importing regions acting strategically in response to low prices? We're not really seeing it in terms of the stock forecast right now because we haven't really got a handle on, and forecasters haven't really got a handle on how importers are going to react to low prices. And it's something we're not going to have a handle on until we progress a bit further through the season. But it's a factor to be aware of. I guess the only caveat is there the quality wheat in the world to attract the interest of these parts. So that's the import side. Let's just jump over to the export side and consider where we might well be at the end of the season in terms of exportable wheat stocks. The world, since 2007, has had a growing obsession with the position of exportable wheat stocks. Where are they? 2007-8 was the year that the world nearly ran out of exportable wheat stocks. Ever since then, there's been a keen interest to understand where are the stocks. This year, generally, there's an expected increase in exportable stocks, only the highest since 11-12, so we're not really looking at record-breaking levels by any stretch of the imagination, and we should expect these levels to change as we learn more about domestic demand and we learn more about trade as well. Area of interest really is the US. The world loves US wheat stocks. It is essentially the comfort blanket for the world because if you have an issue somewhere in the world, you can buy US wheat, you know what it is, you know it's there, you know it can get exported, and that's why it's so treasured. Expectation is that there may be a slight rise in exportable wheat stocks in the US. I don't think we can have that level of confidence just right now. We need to let the rest of the season progress forward. Let's just change tack a little bit and focus really what's happening in Australia. There's been a lot of talk about Australia. I'm going to speed up a little bit. I'm just conscious of time. The map here is just looking at September rainfall. Here are your key wheat-producing regions. And it's seen that we've had a relatively dry September. So that's causing a little bit of concern. There's been an elevated discussion around El Niño. Will it or won't it occur? What will the impact be? I think the key thing on Australia right now is that it isn't 2007. So at the moment, the Australian wheat crop is not going to fall in half. And we need to contrast this to what else was going on in 2007 with the fact that in 2007 we had major crop issues across the Northern Hemisphere. We do not have major crop issues across the Northern Hemisphere in 2014. So even if we have some issues in Australia, there's more flexibility in Northern Hemisphere supplies to deal with it. That's not to say if something does happen that it can't lend support to prices. For all you enthusiasts out there, here's a bit of a schematic that Helen Plant, our senior analyst, pulled together on El Niño. If you want to know the ins and outs of what it works, I'm not going to go into it right now. There is just a sort of a tail-end impact of what El Niño could bring us if it does develop through the winter, and this is where we need to focus back into the US market. Just for context, two of the main types of wheat produced in the US, soft red winter, hard red spring, but the one I'm interested right now is hard red winter in those real heartland states of Kansas, Oklahoma, Texas. And in recent years, the production of that type of wheat has really been dogged by pretty bad drought conditions. And the thinking behind El Niño is if it does occur through the winter, it's going to bring some wetness back into those southern states. Let's just have a look at this chart, looking at the scale of the drought in Kansas, the US's biggest wheat-producing state. And we can see that currently, actually, we're on a par with last year. But if we get some wetter conditions on the back of El Niño through the winter, we shouldn't be surprised if we see a spike up in US wheat production in 2015. I've skipped several steps there, but you can see that the beginnings of it is there. There's the wheat summary for you to take away and explore in your own time. Let's touch on barley. Barley is phenomenally interested. interesting this year. It's a huge sort of niche within the world grain market. It will follow the general pricing because it needs to maintain its demand. The bulk of demand is for feed, of course. But we're looking at a real contrast in terms of supply and demand for barley. Actually, production is lower. There's actually a deficit, and actually stocks-to-use ratios for global barley is actually looking quite tight. This is really, really interesting when we consider that this year the UK has produced 7 million tonnes of barley for the second consecutive season. We haven't done that since 96-97, so we need to keep this in mind. Just to give you some barley context, this is what's going on around the world. I'm going to touch on some elements here. I'm not going to go into the details right now. Australia, we've just touched on the wheat side. Australia could actually be more important to the barley market than it is to the wheat market. What we're seeing is a reluctance of Australian farmers to come forward right now and putting forward sales because they want to see the crop in the bin before they commit to the market. At the moment, Europe is the place to go if you want to buy serious quantities of barley. Touch on Canada very, very quickly. And we've been really used to Canada being a huge powerhouse of barley production and exports. That is now coming to an end. This is a graph looking at planted areas over the last 20 years, and we can see just how dominant rapeseed or canola has become. We were seeing actually a decline in wheat, and until recent years we've seen a stabilisation. But it's only when we look at what's happened to barley do we get an extent. Barley has really been the biggest loser here, losing over 2 million hectares in Canada. That's equivalent of double the size of the UK barley area, essentially. And that's really opening the door. And you kind of have to think, actually, is there a niche developing in the global market that somebody needs to exploit on barley? You know, it seems to be in parts of the world where you can grow soybeans, you can grow maize, barley is being marginalised and pushed out into other areas. So I think it's something I'm really keen to keep an eye on. There's the barley summary at the global level. We're going to jump into the European grain market right now very quickly. I'm going to take you through my thinking on this right now. And it's been a bit of a breath of fresh air from a UK point of view. It's been quite nice to see mainland Europe having a wet summer for a change and us not getting all the rain. We've been sharing the wealth. But it has come with really two double whammies. And we need to consider what the impact of this wet summer has been. First of all, we need to consider it from a yield point of view. So let's just put up two charts here looking at French yields and German yields. The top lines there are maize, and you can see that both of those countries, both of the big producers, have seen spikes above that 5-year average for the first time in a number of years. It's also lent support to the German wheat yields, not necessarily to the French wheat yields so much. So that's been the first element. Because maize is that much later growing, it was able to benefit from that summer moisture to able to boost yields. At the same time, though, that summer moisture came in and caused a huge amount of issues, particularly for French wheat quality. If we consider that we look at the grade 1 French wheat, around typically 20 million tonnes of that is produced. That's wheat with a Hagberg of minimum of 220 seconds. This year, though, that's only 7.5 million tonnes. So it's about a third of what we normally expect to see in terms of French wheat grade 1. If we look at the other end of the scale, French grade 3 milling wheat doesn't come with a specified Hagberg, but we see that we've got 17 million tonnes of that wheat in the marketplace, up from around 4.5, 5 million tonnes typically. And so that's a real shift in European wheat quality, has caused huge issues. It's raised questions, what does the European wheat futures contract represent? Because there's always an appreciation or an assumption that French wheat is of an exportable standard, and that this year is really challenging that. And so the market is having to deal with this. This is why we now need to consider the whole European production context, because not only have we got a big wheat crop with a larger proportion of that wheat crop coming in as feed quality, we've also got bigger production of the other grains, maize particularly, and in terms of total production, we're on a par with what we saw in 2008, plus the wheat issues. Now, I don't think we should spend too much time in trying to decipher just how much of the wheat crop it has been downgraded to feed, because I think that's a very difficult task to do, and I would even suggest it's impossible, because it's about looking at the value of an individual commodity, what is the value to an individual processor, and what at a particular time might be feed wheat to somebody may actually have some milling wheat properties elsewhere. So what we shouldn't expect to try and do is find a clear line between what's feed wheat and what's milling wheat. It's a grey area, and it's a moving grey area as well. So let's not get too hung up on trying to get the precision out of the numbers in terms of a precise split. Let's just look at the headline EU wheat supply and demand from the EU Commission. I don't want to spend too much on here. The headline is, you can see on the diamonds there, that there's expected to be a rebound in the stock-to-use ratio. Let's not read too much into that right now because we've been caught out by this before, in that Europe has exported itself out of these issues before. Not to say it's going to export fully out of this issue, but if we look at the export licenses to date, we're only 3.6% off of last year's pace. And if we look at the total season forecasts, that suggests a 16% year-on-year decline. So don't be surprised if we start to see export estimates expanding slightly for the EU, with stock levels gradually coming down or imports rising, as we saw in the old season. That just gives you a summary of European wheat production. Very quickly, you can see where we've seen the big issues. And really, if we look at somewhere like Germany, have we seen bigger yields coming at the expense of protein content? And I dare say that the evidence is there to take us through that. Let's touch on maize very quickly. And the European maize market has actually become very interesting this year. Basically, on the back of that wet summer, we've had this huge surge in production. That's only half the story because we need to consider maize imports as well. Maize imports have been stubbornly high, or the import licenses have been stubbornly high relative to the size of the crop, and despite the fact that we have now seen the reintroduction of import licenses, that doesn't at the moment seem to be slowing the pace. Demand is going to fail to fulfill all of that that supply, simply because we've got a very congested feed grain market with essentially the amount of wheat knocking around, and particularly lower grade wheat as well. The price graph here just gives you an indication of really the race to the bottom in the European feed grain market. And this brings us very nice to consider what's happening in the barley situation. Again, not going to get into the detail because a lot can change, but just look at the pattern in those diamonds. The elevation in those stocks-to-use ratios is expected, but the same caveat applies. Europe seems to be very good at exporting barley right now. Just look at the export licenses, look at those markers, and look how we're storming ahead of that broken line. And this could well be Europe's interaction with that very finely supplied global market, waiting for the Australian crop. And the test will be, is when we get the full flush of the global or the Northern Hemisphere maize harvest, how can barley compete in that environment? But is there enough, does barley have enough of an edge? Is it enough of a specialist feed grain edge to be able to weather that storm? Quite possibly, but price is going to be key. Let's get into talk about malting barley prices, the whole complex in terms of European barley pricing. We see the feed barley price trending low at the bottom, but we see the development of a malting premium. In part coming off the back of French quality concerns, but now we're seeing very good condition, good quality malting barley being offered into the market out of Scandinavia and indeed the UK. May all be reflective of the fact that we see strong demand for those commodities from a global perspective. Europe seems to be flexing itself as a very competitive barley exporter, and may all have to, because there may not be room in the domestic market to meet all of that demand. So there's your European grain summary. Again, a way there for you to take away and to digest in your own time. Really wanted to get into the final sort of part of the presentation, which is designed to really to look at the UK situation. Fortunate enough to have the supply and demand information released yesterday. I'm sure all of you have taken some time to have a look at that. And really the theme is getting back to exports, really from a wheat perspective. I think the UK supply and demand is a really good story to tell if you're looking to tell a story about how something's moved from one extreme to the other. And this season, 2014, is essentially how the UK wheat market, UK wheat production has moved from one extreme to the other. So let's build the supply and demand for you right now. And let's have a look at the opening stocks. But it's when we get into the production, we saw this huge surge in production. Now, we're quite fortunate in that we have access to production data right back to 1893. And if you look at the year-on-year change in UK wheat production into 2014, this is the largest upswing in UK wheat production we have ever seen year on year. That just sets the challenge and sets the gauntlet for what the market has to achieve over the remainder of this marketing season. In terms of, we're exiting out of a period of 2 seasons where we've essentially been net exporter, a huge crop, and we have to get that wheat into the export market. The market has to recapture that demand. So let's look at some of the demand numbers and the expectations. An expectation that demand will be recaptured domestically from imported grains, but also from in the domestic feed grain market away from barley. But here comes the interesting bit. We need to consider how the level of surplus is going to be dealt with, and this is what we're looking at. So the historical bars here, the red bars here, are really our exports. The blue portion of the bar are our closing stocks. The huge black bar on the right-hand side there is essentially a combination of those two, the balance, if you will. So a 4.8 million tonne supply and demand balance, really the highest since 2008-9. So it's not a record-breaking balance of wheat. We've had this scale of surplus before. The challenge is that we're coming into this season having been net importer for 2 seasons. And normally we have a lead-in, we see quite a number of forward sales on the export books, and we've got a head start. This year we're seeing a very sluggish start to the export campaign, and so the likelihood is that we're going to be reliant on stocks on farm and in the supply chain to help balance this rather than be purely reliant on exports. And we can see it in the market. The market is pricing it. If you look at it has been publicised quite a lot by ourselves, you can look at the premiums into the new crop at the basic futures level, and you can see that there's a carry. There could well be an incentive there, given that interest rates are quite low, and it's certainly a technique that's being used to try and weather some of this low price storm that we have at the moment. We need to touch on domestic wheat quality, and it's very similar situations we see elsewhere. And the data here is coming from our second release of the Cereal Quality Survey. There's a whole host of data on the website for you to interrogate if you so wish. And we're looking at the full spec bread wheat here, so the 13% protein, the 76 kilo weight, and the 250 Hagberg, and looking at what proportion of those samples at a GB level are meeting that specification. So in the middle numbers, in 2013, we had essentially 37% of samples meeting that. In 2014, just 14% of samples. Look at the bottom, Hagberg's on par. Specific weight, we're actually trumping what we saw last year. It's that protein element there, 53 last year, just 19% of the GB samples have met that full spec. And it's the same, we get that same level of drop down year on year when we even come down into lower grades, so down to 12.5 and even lower, we still see that drop down. And that's the huge challenge that we have. Interesting that there's some interesting regional patterns. The general trend is that the further north you go, the less the drop down is year on year, but there is still a drop down. So the markets will be incentivizing to find the quality. And this is certainly not a year to be over-delivering protein content in milling wheat. Let's consider what the price implications of this have been. And again, just as we've seen in the global market, we have this huge spectrum of wheat prices. And this is not a year to be generic about the domestic wheat market as it is, just as it is on the global scale. The broken line there at the bottom is the delivered feed wheat price into East Anglia, which has fallen probably below most people's expectations. The solid lines at the top are looking at the benchmark Northwest bread wheat price and the imported German A wheat price. So you can see that huge spectrum in premiums. Let's look at this in another way, and let's consider the domestic Northwest delivered price against the futures, and we're looking at the premium of that as a percentage of the total price. Typically, we're used to seeing a premium accounting for somewhere in the region of 10 to 15, maybe even 20% of the total price. Now, though, recently, the premium is basically accounting for more than 30% of the total milling wheat price. It's hugely important that we appreciate what's going on, that the milling wheat market is made up of the feed base price and of the premium. We've essentially got two very active, very volatile markets in one price. And so from a risk management point of view, it's important that we manage those prices very, 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 very separately. And we don't take a generic trend of, say, the price trend of futures or the carry on futures and we apply that to the milling wheat price. That's a very dangerous thing to do because it can give us some quite misleading results. Let's touch on barley. We're going to build the supply and demand now. Coming out of last year, we had quite a lot of higher opening stocks, but then look at the production. Another big barley year. This is the second consecutive year that the UK has produced 7 million tonne plus of barley. We haven't seen that level of consistency since 96, 97. The big difference is that in 1997, we put 1 million tonnes of that barley into intervention. We do not have intervention available at all to manage the barley market. Now, I will leave it to individuals to decide whether that's a good thing or a bad thing, but it's actually letting the barley market work rather than allowing accumulation of stocks in the domestic market. The next challenge comes in demand because we know we've got that bigger wheat crop coming in and the prices are being very competitive. So we would expect less demand from feed compounders for the domestic feed barley crop, and this gives us a similar situation, a very big surplus to deal with, and certainly the biggest S&D balance we've seen in the barley market in modern times, certainly in this post-intervention era that we have. In terms of quality, it's another extraordinary year in that we're looking at relatively low nitrogen levels, 2 years of low nitrogen. And I think we need to be careful with malting barley for 2 reasons. And it's developing what I would call a dry spring risk is building for our malting premiums. Essentially, the European brewing market is taking more of a focus towards spring-type varieties. As the market becomes more Europeanized, that's filtering down into the UK. But also, from a UK point of view, the distilling demand, of course, is operating in that spring barley arena as well. So we're seeing a segmented market. The winter barley market is largely driven by high-yielding feed varieties. There's an element of winter malting barley in there, but we can't treat winter malting barley as a commodity element anymore. It's becoming more specialized and increasingly more contract-based. And the spring barley area is becoming more and more dominated by the malting-type varieties. And so this malting demand is shifting more and more over to the spring side of things. And have we got complacent to it? I don't think we have, but we've just had a couple of low nitrogen years, and so it hasn't really caused us an issue. Where we get a dry spring is where we get high nitrogen spring barley, and that can potentially give us a lot of volatility in the malting premium. The market will sort it out as and when it happens, but we just need to be aware that there's a risk of that happening. As the graph shows, we've got a huge surplus of barley to deal with. How are we going to deal with it? Well, we're going to carry on, likelihood is, in the same direction of travel as we did before. And the data here comes from our Newmarket data centre on the HCCA website. Martin Pettifer's here if you'd like to understand more about the data that we've got available and how we're visualising it. But essentially what we're visualising here is how we've been able to access those, or the markets that we've accessed. Last season we saw 35% of our barley exports going to non-EU countries. And we'd have to do the same this year, maybe even more, given the fact that we've got such a congested EU feed grain market, plus the opportunity, the fact that the global barley market looks like a big opportunity for the UK. There's another issue emerging as well, and it's one of currency. The chart here is just indexing the value of sterling in the green against the euro and the blue against the dollar. And we can see over really the last few months, we've seen a spreading in these trends. Essentially, sterling's been appreciating against the euro, basically because Eurozone economy just isn't in the shape that the UK economy is. On the flip side, though, there's more hope for the US economy, and so we're actually depreciating against the dollar. And that's pushing the dimensions somewhat, because it's becoming more difficult to export into Europe because of the sheer supply of feed grains, but the currency and the global barley opportunity may actually indicate that we have the opportunity to do more third country business as a share than we have done. Just moving on a little bit more, this is just to give you the historical context for oats, just to complete the picture for you. We don't have oat data for the new season yet, so we're still running on the old season. The big issue for oats really is going to be dealing with the legacy of last year's huge crop, the biggest crop in 40 years. And really we should start to see a return to normality for the oat market in terms of oat production is going to have to buy some acres in to ensure security of supply, in my mind, in the medium term. The three-crop rule may well bring a dynamic to it, but I don't think we can guarantee it. So the oat supply chain is going to have to innovate to sort of stay competitive for acres going forward. Just to broaden our horizons and to set the scene as we head into Julian's paper on oilseeds, and we need to appreciate what's going on in the UK oilseed sector. A clear price trend over recent months and years for UK oilseed rape. It wasn't too long ago that we were looking at oilseed rape, and it was on many farms seen as the most profitable crop. The massive decline in prices has changed that somewhat, and then throw into the mix the issues with neonics and three-crop rule potentially, and it's looking a little bit different. Do I foresee a mass exodus from oilseed rape? I don't think so. But it's going to broaden our horizons, and it's going to force us to think about broadening our break crop portfolio and potentially looking at pulses again as part of a complete rotation. There's the UK summary. I think we'll look back at this year and the last 2 years and think that was a huge bit of transition for the UK to go through. This is a benchmark year. Last year was a benchmark year, and so make sure you keep your memories of it, and you can use it in many stories in years to come, I'm sure. Just really to really close with my overall summary now, and really what my key messages are. Essentially, we're in a spot market situation where we've had another big grain surplus. The big issue is that the market no longer has to be concerned about spot supplies of feed grains. Not had that luxury for a number of years, and so that explains why we've dipped down to these low levels. At the same time, the market is more than aware that demand continues to grow, and we're only one weather event away from not being able to meet that complete demand, and so one weather event away from stock drawdown, and so one weather event away from a price rise. The market will only respond when that weather event happens, and the key is to capitalise on it rather than to speculate on what might happen next. It's about risk management. We have to be very careful with the weak market. It's become very, very complex, and we have to appreciate both what's happening with the feed-based price and the premium to give us a complete picture. We can't generalise about either or part of that price. And really, I suppose if we want to talk about success, and we want to talk about marketing success, I suppose largely now for the 14-15 season, a lot of the success has already been determined by good price risk management, effective price risk management. There's a long way to go for the season. There's a lot of unmarketed grain left to come to market, and that's going to need very careful management. A decision is going to need to be made of how are we going to price that, when are we going to price that, are we going to carry it to the new season, are we just going to follow the rallies, sell the rallies. The key to it will be information, and the key will be timely information. This is really one of my biggest justifications for wanting to bring the industry a daily market report. I'm really proud today to be able to launch to you our new product, our Grain Market Daily. This is a project that one of our newer analysts, Brenda Mullen's been working on, and she's done a great job. And I would like to thank those in the industry that have given us a huge amount of support and feedback in developing this service. It's a daily market report. It complements our current offerings. It's web-based on the HCA website every lunchtime through social media, but also through email as well. So sign up if you'd like to receive the emails. This is kind of a new step for us in improving our timeliness service to levy payers. I'm really interested to know what you think and hope you can make the most of it. That pretty much concludes it. I was a little bit worried about the time, but I think we've just about got away with it. And thanks very much.
Wow, I think I feel exhausted, Jack, by you charging through that lot there. There's an awful lot of information. We've got just over 5 minutes. There's 2 roving mics. Because of the lights, it's not because I can't remember your name. I can't see you very well. So please put your hand up, get a roving mic to ask questions, and we'll get somebody to you as soon as we can. Questions, please, for Jack. I believe we're all bashful and there's no questions. Right at the front here, please, good Mike.
Thanks, Jack. Could you just give us an insight into what you think the effect of the Common Agricultural Policy changes might be on EU grain?
Sorry, name, please. And
yeah, Graham Birch from Field Barn Farm. Thank you.
You haven't got 2 hours for that either.
Right. I think it's difficult to speculate too much about it. Sort of, I think the biggest element will be the 3-crop rule element. But in terms of its overall impact, I don't think we can expect for it to have a major impact. There'll be impact at the fringe. And I think what we need to think about, it's going to have a bigger impact on, say, something like the pulse market than it is on the grain market, because a big area to the pulse market is quite a small area to the grain or the oilseed market. So I think if you're looking at it, and I don't see a massive material impact to the grain market, but it could potentially have a bigger impact to the smaller crops such as the pulses.
Next question, please. John.
Yeah, Jack Ian Backhouse, farmer grower. How do you see the Russian trade ban of the EU impacting on the grain markets? Not directly specifically, but it's already having an impact in the livestock market, in the pig sector. How will that feed through, given that we've got a lot of feed grains to get rid of?
Yeah, so it's a complex one, and I think there are potential indirect impacts to the grain market. The first one is, of course, if it's impacting then livestock profitability in Europe, then that can have a feed impact to EU feed grain demand. I think this season, though, that's going to be trumped more by the fact of the sheer supply of feed grain in the EU market than that sort of knock-on impact. The other element is quite more interesting, and we have to look into Russia itself to have an understanding of it. In that there's a thinking that the Russian ban will then increase demand for Russian animal products, and does that increase then internal Russian demand for feed grains? Quite possibly. I think either way, I don't think they're going to be huge drivers, and I think in the context of weather and the shifts in supply, I think this is likely to be fairly minor.
Any other questions before we move on? Jack, could I ask you one? Looking at the slides, you've got a number of references to USDA and to the European Commission. I've always sort of seen the USDA as being the source of information. When you see the volatility we talk about, are we doing enough in Europe to monitor global stocks and prices and trends?
As an analyst, I can never have enough information. I think, and you might remember last year, we timed the conference to coincide with domestic supply and demand numbers, but also to get the latest October USDA report, which came out on Friday last year. Unfortunately, we didn't have the luxury of the USDA report because of the federal shutdown. I'm very thankful that we've got that. But certainly, timely information is becoming more and more important, and you almost do look across at what the information you get out of Washington. You look at it with some envy, because I can tell you a lot more about what's happening with the Illinois corn crop than I can tell you about the French crop, for instance. And so, as an analyst, you can never have too much information. It's not always going to be relevant all at the same time, but it drifts in and out of importance. So yeah, more information, the better from my perspective.
Thank you, Jack. Thank you, Russian. So I've got one last question in the middle here before we move on. I've got just a couple of minutes.
Yes, Stuart Hutchings, grower from Herefordshire. Can I ask Jack if he's looking ahead to the 2015 crop and 2016 crops, would you see the current futures increases on present futures as an opportunity to sell now, some it forward?
Is that the time? Right. It's always it's one of the most popular questions we get, and I think
remember, Jack, you're on film now. So.
I know. The challenge is we never know what is around the corner, and I think it's a very individual choice, and it's one that really needs to come down to what the individual business need is, and we must avoid getting too complacent towards what the market can do. Let's face it, and it's a big if, of course, at this point, we see a good weather or a benign producing season across the Northern Hemisphere in 2015, that will undoubtedly provide downward pressure on prices. And so there's undoubtedly a risk to it. On the flip side, of course, if we get a weather event, then we're going up. And it's about understanding and establishing the level of risk you want to take as an individual business. I'll often have a discussion with farmers about, and they'll say, I've thought about it, and I'm going to do nothing. And I think that's fine. As long as you've thought about doing nothing, and it's a conscious decision, and you've made the scenarios, let's pick a number out there and say, okay, if we're going to do nothing, how does the business look with the next farm wheat price of below £100 a tonne? And then that tells you if you need to take action. But I think we need to look beyond just working around fixed price selling. I think we need to look at being able to gearing ourselves towards minimum price protection and keeping ourselves open to upside opportunity. I know, and this is a huge part of business management, and there's a bit of a plug coming here for the HCCA regional team, because there's a huge amount of investment going into the regional team to really help with business discussions like this. I know that Richard and the team are here, so feel free to pick their brains about the work that team are doing in terms of business improvement.
Brilliant. I think it's a really good time to move on. Thank you very much indeed, Jack. As always, a really insightful